The financial advisory business seems to love complicated investment programs. At Dow Wealth Management, we don't. In our view, there are only a few optimal investment strategies. We propose that you own a broadly diversified portfolio of securities directly in a separately managed account. But which securities? Let us draw you a picture. First, we recommend high-quality stocks. These are the common stocks of companies with strong balance sheets and consistent earnings. Solid companies that are likely to be around for a good long while. But we don't recommend all of them. More on what we don't recommend in a moment. Second, we recommend growth stocks. As the name suggests, these are companies with above-average sales and earnings growth. But not all of these either. There is a group of the high-quality stocks that are also growth stocks. These are the companies we recommend to our clients. Solid companies with the potential to provide solid growth. But wait, there's more. To safeguard our clients' principal, recommendation number 3. High-quality, investment-grade bonds issued by borrowers unlikely to default on either principal or interest. But to protect against rising inflation and interest rates, we make recommendation number 4. Only the short-term varieties of these bonds. That's it. What could be simpler? 4 time-tested criteria for sound investing that help mitigate the risk of irrecoverable loss, ensure stability, and position our clients for solid returns. Now, remember we said there would be more on what we don't recommend? Here are a dozen things we typically advise an investor not to do. We don't recommend mutual funds or variable annuities. They tend to underperform the markets in which they invest and suffer tax inefficiencies. We don't recommend index funds or exchange-traded funds. By design, they commonly contain low-quality and low-appreciation potential securities. Worse, during dynamic markets, bundled portfolios leave investors with limited options. To lessen exposure to the high-risk stocks in their funds, they have only one choice: sell everything or sell nothing. We don't recommend so-called value stocks because the quality and prospects for the underlying companies tend to be poor. We don't recommend asset allocation by market capitalization. Market capitalization is not a good indicator of quality. Respected securities rating systems are more reliable. We just say no to market timing and sector rotation trading. Successful investing starts with the humility and good sense to know what cannot be done. We don't recommend structured investment products. They tend to be complex, inefficient, and they may expose investors to credit risk and a lack of liquidity. We don't advise covered calls to generate income. While the strategy sounds sophisticated, it ensures only limited gains on the few big movers that get called away, while saddling investors with underperforming stocks that remain. We don't recommend long-term bonds or preferred stocks. They expose investors to an enormous downside risk should interest rates rise. We are not fond of real estate investment trusts. By owning common stocks, most investors have significant exposure to this asset class already, and even more if they own their own homes. We don't recommend commodity funds. While they might seem like a hedge against inflation, after investment costs, their inflation-adjusted long-term returns are often negative. We don't favor a sum-of-everything portfolio strategy. Over time, only a few asset classes can be expected to perform especially well. We concentrate on those. We don't recommend foreign stocks. In a portfolio of major U.S. companies, 30% to 40% of corporate earnings may come from overseas. You don't really need more exposure to foreign markets, especially if it's implemented through costly mutual funds. There you have it, a dozen potentially suboptimal investment strategies other advisors often recommend that we don't. Because the 4 simple principles we do recommend have guided our investing success for over 80 years. Buy equity in high-quality companies with above-average prospects for growth, and buy short-term investment-grade bonds to safeguard principal and mitigate volatility. With a sound, simple, time-tested investment philosophy, Dow Wealth Management builds portfolios of securities from only the most optimal categories for its clients, offering the potential to maximize long-term returns. Give us a call to learn how to put our investing principles to work for you.